Picture this. You're queuing outside a tiny tea shop in Toronto, 2008. Everyone's talking about this new place that sells $30 per kilo loose-leaf tea to 20-somethings who Instagram their daily brew. It sounds mental, but the queues keep getting longer. This was DavidsTea at its peak. They had somehow convinced an entire generation that premium tea was worth cafe prices. The business model was bulletproof, high margins, loyal customers, and a product everyone drinks daily. But here's the thing about riding a trend wave. Somehow, the company that turned tea drinking into a premium experience managed to completely crater their own IPO. What should have been a triumphant public debut became a masterclass in corporate face-planting. The brand that made tea cool is now a shadow of itself, and their public offering? An absolute disaster that lost investors millions of dollars. So how did a company with such a simple, profitable idea get it so catastrophically wrong? DavidsTea is the latest victim in a retail collapse that has been particularly brutal to specialty chains. More locations are closing their doors permanently. The company that once boasted over 240 stores across North America now operates a fraction of that number. This is a brutal fall from grace. At its height in 2016, DavidsTea was generating over $200 million in annual revenue and was positioned as the next big thing in experiential retail. Today, it is a cautionary tale that investors and business schools study as an example of how quickly things can go wrong. The IPO that was supposed to fund global domination instead became one of Canada's most spectacular public market disasters, wiping out shareholder value and destroying expansion dreams. Was this always DavidsTea's final unbeatable boss fight? To understand the fall, you have to look at the rise. This story starts back in 2008 in Montreal, where cousins David Siegel and Herschel Siegel had a simple but revolutionary idea. They looked at the North American tea market and saw something that felt completely backwards. While coffee culture was exploding with specialty shops and premium experiences, tea was stuck in the past. You had your basic grocery store tea bags on one end and intimidating traditional tea shops that felt more like museums on the other. There was nothing in between, nothing fun, accessible, or designed for a younger generation. The Siegel's vision was brilliant in its simplicity. They wanted to make tea as exciting and social as coffee had become. They created a retail experience that was part tea shop, part lifestyle brand, part discovery platform. The stores were designed to encourage exploration. Walls were lined with glass jars full of colourful, loose-leaf teas, each with names like Movie Night and Birthday Cake that felt more like cocktails than traditional Earl Grey. The original Queen Street West location in Toronto became an instant hit, drawing crowds of curious 20-somethings who had never considered loose-leaf tea before. The store's design was deliberately inviting, bright, modern, and approachable. No stuffy tea rooms or intimidating tea masters here. Instead, friendly staff encouraged customers to open those glass jars, breathe in the aromas, and discover new flavors they might love. This was a revolutionary approach to tea retail. Traditional tea shops had always treated tea with reverence, bordering on solemnity. DavidsTea turned it into something fun, experimental, and social. Tea was not just a beverage anymore, it became a lifestyle choice, an identity marker for young professionals looking for alternatives to coffee or alcohol. The timing could not have been better. The wellness movement was just beginning to gain momentum, and DavidsTea positioned itself perfectly at the intersection of health consciousness and indulgence. Their marketing brilliantly emphasized both the wellness benefits of tea and its potential as an everyday luxury. DavidsTea exploded onto the scene at the perfect moment. This was the height of the artisanal everything movement. Millennials with disposable income were actively seeking out premium alternatives to mass-market products, such as craft beer, specialty coffee, and artisanal chocolates. The company's growth was absolutely explosive. They went from a single Toronto location to dozens of shops across Canada in just a few years. The formula was simple and incredibly effective: prime locations in busy shopping centres, Instagram-worthy product displays, knowledgeable staff who could guide newcomers through flavour profiles, and prices that felt premium but not prohibitive. By 2012, they had expanded into the United States, opening flagship locations in Manhattan and other major cities. The brand became synonymous with making tea cool for a whole new generation. Their seasonal collections created genuine excitement, and customers would line up for limited edition holiday blends the same way sneakerheads queue for rare releases. The numbers were intoxicating. Same-store sales growth was consistently strong, customer loyalty was off the charts, and the profit margins on loose-leaf tea were substantial. This was not just a retail concept, it was a movement. DavidsTea had created a community around their brand, with customers proudly displaying their branded thermoses and tea tins as status symbols. Their product innovation strategy was particularly clever. Rather than overwhelming newcomers with obscure tea varieties, they created accessible blends with familiar flavor profiles, including dessert teas, fruity teas, and comforting classics with a twist. This made the transition from coffee or soda to premium tea much less intimidating. But no good thing lasts forever. The first warning signs appeared around 2014, just as the company was preparing for its public debut. The specialty retail landscape was becoming increasingly crowded. Competitors started copying the DavidsTea model, and bigger players like Starbucks began expanding their own tea offerings. More troubling was the changing shopping behavior of their core demographic. The same millennials who had flocked to DavidsTea's physical locations were increasingly shopping online. The experiential retail magic that worked so well in store was much harder to replicate digitally. The Instagram generation was always hunting for the next new thing, and DavidsTea was no longer it. The company's expansion strategy also started showing strain. Opening new locations in secondary markets was not generating the same buzz or sales volumes as their flagship urban stores. The business model that worked brilliantly in downtown Toronto and Manhattan was struggling in suburban shopping centers. Meanwhile, the retail real estate market was becoming increasingly expensive. The prime shopping center locations that DavidsTea needed for foot traffic came with sky-high rents that put pressure on profitability. Internal challenges were emerging too. The rapid expansion had stretched their operational capabilities. Quality control issues began surfacing. Supply chain management, which had been relatively simple with a dozen stores, became exponentially more complex with hundreds of locations across 2 countries. Perhaps most concerning was the shifting sentiment among their core customers. The novelty factor that had driven initial growth was naturally fading. The $6 cup of premium tea that had felt like an affordable luxury during economic good times started looking like an unnecessary expense as economic uncertainties loomed. Despite these warning signs, company leadership pushed forward with their IPO plans. The promise of public capital was too tempting to resist, especially as they eyed global expansion opportunities. But they were about to discover that public markets can be brutally unforgiving of business models with cracks in their foundation. Digital disruption hit hard. The company that had built its success on physical discovery and in-store experience was completely unprepared for the shift to e-commerce. Their online platform felt like an afterthought compared to digitally native competitors. The mall death spiral became a real threat. DavidsTea's expansion strategy depended on shopping center locations. As foot traffic to malls declined throughout the 2010s, their core business model came under severe pressure. Competition squeezed margins. Bigger players with deeper pockets began muscling into the premium tea space. Grocery stores expanded their specialty tea sections, coffee chains added premium tea options, and online retailers offered convenience that physical stores could not match. Trend fatigue set in. The artisanal movement that had fueled DavidsTea's initial success began to plateau. Consumers started looking for value and convenience over premium experiences, especially as economic uncertainty grew. Each of these factors compounded the others, creating a perfect storm that would make their IPO timing particularly unfortunate. The company also faced significant internal challenges. Their inventory management was becoming problematic, with excess seasonal products frequently requiring deep discounting. New product launches were not generating the same excitement. Customer acquisition costs were rising as the easy early adopters had already been converted. Perhaps most damaging was the disconnect between the company's public market narrative and retail reality. While DavidsTea was telling investors about global expansion opportunities, store-level economics were deteriorating. The growth story that investors were buying into was increasingly divorced from the operational challenges the company was facing. Leadership turnover, became another red flag. In the critical pre-IPO period, the company cycled through several executives, creating strategic inconsistency at precisely the moment when clear vision was most needed. Each new leader brought different priorities, preventing the development of a coherent response to the mounting challenges. These operational weaknesses might have been manageable in a private company with patient capital. But public markets demand quarterly growth and consistent performance, luxuries that DavidsTea simply could not deliver. The IPO launched in June 2015 at $19 per share, raising about $67 million for expansion. But almost immediately, things went sideways. The stock struggled from day one, never maintaining its opening price, and it steadily declined as investors realized the fundamental challenges facing the business. The money raised was supposed to fund aggressive expansion, but instead it highlighted every weakness in the business model. New store openings were generating lower returns, same-store sales growth was slowing, and the company was burning through cash, trying to maintain growth targets they had promised public investors. The final blow came with the retail apocalypse that accelerated in the late 2010s. Shopping centers across North America were hemorrhaging anchor tenants, foot traffic collapsed, and specialty retailers like DavidsTea found themselves paying premium rents for locations that no longer delivered premium results. By 2020, the company was forced into creditor protection, closing the majority of its US locations and dramatically downsizing its Canadian footprint. The quarterly reporting cycle became a nightmare for management. Each earnings call revealed widening losses and declining metrics. Investor confidence evaporated. The stock that had debuted at $19 was trading below $1 within a few years, a staggering destruction of shareholder value. Attempts at strategic pivots came too late. By the time DavidsTea began seriously investing in e-commerce and trying to reduce its mall dependency, the company's financial resources were already severely constrained. The aggressive lease commitments they had made during the expansion years became anchors dragging them down as retail traffic patterns changed. Internal conflicts further complicated recovery efforts. The founding family maintained significant ownership, and disagreements between major shareholders and management created governance challenges that made decisive action difficult. Boardroom battles became public, further eroding investor confidence. DavidsTea's initial public offering, or IPO, represents a perfect case study in timing and market misreading. The company went public just as the retail landscape was shifting fundamentally. The experiential retail model that had driven their success was becoming a liability in an increasingly digital world. This was not just about tea, it was about the broader collapse of specialty retail chains that had built their success on physical locations and curated experiences. Across North America, similar brands faced the same squeeze: rising rents, declining foot traffic, and changing consumer behavior. The timing of the IPO could not have been worse, launching just as the retail apocalypse began to accelerate. DavidsTea's story is part of a larger retail transformation. The same forces that crushed their business model were simultaneously creating opportunities for digitally native brands with lower overhead and greater flexibility. While traditional retail struggled, direct-to-consumer models thrived. The company's struggles also reflect the challenges of maintaining a premium positioning in a commodity category. Tea, unlike coffee, proved difficult to sustain as a premium experience worth paying substantial premiums for. The perceived value gap between grocery store tea and DavidsTea's premium offerings was not sustainable for many consumers once the novelty wore off. Was DavidsTea's fate inevitable? In hindsight, the warning signs were all there. A business model dependent on high-rent retail locations, a demographic increasingly shopping online, and a product category that was becoming commoditized. But perhaps there was another path. Had they prioritized digital transformation earlier, focused on building a subscription model, or found ways to recreate their in-store magic online, the story might have been different. What's undeniable is that DavidsTea succeeded in changing how a generation thinks about tea. They proved there was a market for premium, accessible tea experiences. They just could not figure out how to make that translate to sustainable public company growth. Their legacy lives on in how many of us now approach tea as something worth seeking out quality versions of, something with varieties worth exploring, something that deserves more attention than dropping a generic tea bag in hot water. Even as the company itself contracted, the cultural shift they initiated continued expanding. For entrepreneurs and investors, DavidsTea serves as both inspiration and warning, a reminder that timing markets correctly is just as important as having a brilliant concept. A business model perfectly suited for one retail era may be fundamentally unsuited for the next. But what do you reckon? Was DavidsTea's IPO disaster inevitable, or could different timing and strategy have saved them? Did you ever shop at DavidsTea during their heyday? What was your go-to blend, and do you miss that experience of discovering new teas in their colourful stores? Drop your thoughts and memories in the comments below. We'd love to hear your take on whether specialty retail was doomed from the start, or if there is still hope for experiential brands in a digital world. If you enjoyed this deep dive into retail disasters, give us a like, hit subscribe, and tap the bell so you do not miss the next cautionary tale from the business world. Cheers for watching, and we'll catch you in the next one.